January data releases arrive like a weather front, and farmers, traders, and policymakers feel the surge. This topic matters now because a 20-cent swing in corn prices can reshape budgets, futures margins, and plantings for the next season. When a single USDA WASDE update shakes supply expectations, the ripple reaches ethanol plants, feed producers, and grocery shelves. Investors watch headlines while hedgers lock in costs, and small traders search for patterns in crowded markets. The chaos surrounding this data dump arrives at a moment when global grain markets already wrestle with weather, currency, and policy signals. Owners, fleets, and processors feel the uncertainty too. On the surface, this is about a data dump, but the mechanism is straightforward. The January update aggregates crop ratings, stock levels, weather forecasts, and demand signals into one number set that traders use to price futures. A 20-cent move in corn translates into tens of millions of dollars of daily risk for ethanol plants, livestock feeders, and hedge funds. Think of it like a credit rating for a crop season. A single report can reallocate capital, shift planting decisions, and alter logistics plans. Markets react in minutes as algorithms pass the new figures and human traders adjust positions. Background: for decades, corn markets have moved on reports, weather surprises, and policy shifts. The January cadence is particularly potent because it sits after harvest, before spring planting, and amid biofuel policy debates. In 2012, a similar WASDE surprise sparked a dramatic rally, while in 2014 a forecast misread left farmers holding risk into planting. Traders track the data calendar like a sports season, memorizing release dates and reaction patterns. Global buyers remember how China and ethanol demand can swing import needs. Inflation, fertilizer costs, and currency moves add layers, turning one report into a chorus of market questions today. Current market impact. As the January data approaches, futures trade volumes surge and volatility spikes. Traders price in a 20-cent delta as if it were a margin call, with farmers hedging, funds rebalancing, and airlines watching fuel costs for potential feed adjustments. Corn futures rallied briefly on early leaks, then cooled as traders weighed uncertainty about weather, planting pace, and export pace. Cash markets tighten when futures move, lifting basis levels at key storage hubs. Retail traders see meme-ish volatility, while large processors adjust feed contracts to manage risk. The chaos underscores how tightly corn is linked to energy, livestock, and global demand. Who is affected? The January swing touches every link from farm to fork. Large seed and fertilizer companies face input cost shifts and new guideposts for planting forecasts. Ethanol producers adjust margins when corn is expensive, and livestock feeders recalibrate rations as feed costs move. Grocery chains feel price pressures if margins compress, while exporters watch basis and shipping schedules. Hedge funds and pension funds rebalance exposures to agricultural assets, sometimes triggering liquidity moves. Farmers weigh insurance and storage decisions against expected revenue, and cooperatives coordinate with dealers to manage risk. In short, a 20-cent move is a big deal across the entire supply chain. Geopolitical and macro factors. The greenback, inflation, and policy shifts set the backdrop for every crop cycle. A stronger dollar makes U.S. corn less competitive abroad, while currency weakness can spur export demand and tighten domestic bases. Ongoing tensions with major producers, trade talks, and ethanol mandates color the January data, adding risk premia to prices. Weather patterns across North America, South America, and Europe influence carryout estimates as well. Global energy demand and fertilizer price swings feed into farmer planting choices. In short, corn moves are not just about crops, they reflect macro risk, geopolitics, and the pace of global growth. Smart money actions. Institutions are widening hedges, rotating into risk-off agriculture assets, and calibrating long-term supply risk. Pension funds and endowments may increase allocations to soft commodities as inflation hedges, while commodity traders chase curve steepeners in the grain complex. Banks price in scenarios where WASDE revisions surprise to the upside or downside, and energy players adjust ethanol feedstock strategies accordingly. Retail traders swarm chat rooms, yet the most effective moves involve disciplined risk management rather than chasing headlines. Some funds reduce exposure to single crop bets and diversify across options, futures spreads, and storage plays to dampen volatility. Bear case and risks. The downside scenario imagines a January surprise that confirms bumper yields and heavy exports, pushing price lower and roiling hedger portfolios. A bigger-than-expected crop, favorable weather, or policy shifts that curb ethanol demand could deflate corn values rapidly. Liquidity dries up if volatility collapses, leaving late entrants with losses. A misread of weather in South America could derail carryout expectations, while supply chain hiccups re-emerge in storage and transport. Additionally, higher fertilizer costs and energy price spikes complicate margins, potentially forcing bankruptcies among marginal growers or storage operators who financed with short-term debt. How retail investors can respond. Treat this data dump as a risk lever, not a bet you can time perfectly. Start with education on futures basics, options hedging, and how basis trading works at your local grain elevator or broker. Diversify across crops, or use low-cost options to limit downside while staying exposed to potential upside. Build a simple plan. Set stop losses, allocate a small portion to commodity exposure, and avoid chasing rumors. If you own stocks with exposure to agriculture, you may review earnings sensitivity to corn costs. Finally, monitor WASD cycles and weather forecasts for disciplined, repeatable decision-making. Outlook and call to action. The January data dump could keep corn markets volatile through early Q2 as weather clarity improves and planting pace locks in. If traders price in a further 20-cent range, a broad set of players will adjust hedges, storage, and export commitments. The upside depends on tight global feed demand and favorable weather. The downside on bumper yields or policy shifts that spark selling pressure. For investors, the key is to stay disciplined, follow data calendars, and size risk with a plan.